All right, guys, taking a quick look at the week ahead. Our focus once again is firmly fixed on the Aussie CAD, which, as you guys know, is a currency pair that we've been trading from the 1st of December. We've entered into three positions from the first. The first one we took off at 90.60, the second we took off at 91.10. Now we have a running unit left, and obviously we are looking at opportunities to get back in on the long side by scaling into more positions. Now, I think what was very positive last week is despite last week's massive geopolitical turmoil we had equity markets pushing lower quite a bit. We had a lot of support coming in for the safe havens like the yen, like the dollar, like the Swiss franc. But despite all of that, despite that overall negative risk tone, I think the Aussie kept its composure very well. Now, the one thing that's been very interesting, as always, to watch is the market's reaction with regards to some of those classic correlations that we normally see in global markets. Now, if we take a look at this chart, this is just overlaying the Aussie dollar currency index that we've built in TradingView, and we've overlaid that with the S&P 500. Now, normally, of course, the S&P, or rather the Aussie, is considered as a favorite risk proxy. So you would expect the Aussie dollar to broadly follow and mirror what we've seen happening in equity markets. But of course, that hasn't been the case. So when correlations like this start to break down, you often hear some participants say things like the market is rigged, or the market is broken, or something is wrong. But I think when correlations are not working, it means that we need to take a closer look as to why that correlation isn't working. And we think, in line with the broad rationale for that Aussie dollar trade that we've been talking about for quite some time. We think that the reason for the Aussie's resiliency, despite the pain felt in equities, was partly due to some other supporting factors. The first one, of course, being that fairly solid jobs print we had. I mean, there was some negative caveats to that jobs print last week. Like, even though employment was a beat, the majority of that was part-time employment because full-time employment actually contracted. And yes, unemployment rate stayed low, but a lot of that was due to participation. But I think the fact that participation has kicked up to 66.2 from expectations of 66, I think that was a real positive. And overall, it wasn't a negative print with unemployment still sitting at 14-year lows. So apart from that, the other thing that we've been looking at for quite some time for the Aussie dollar is, of course, positioning. Right? If we consider where we are from a positioning point of view, it's still the biggest net short among large speculators, among the non-commercial positions, the biggest net short among the majors. And we are still very, very close to historical lows in terms of that net short positioning. So, it seems for us very strange that the bag holders of these net short positions, why they've been so complacent, I mean, holding on to their shorts despite the recent developments that we've had, despite the market's expectations of rates to rise. Maybe it might be these participants keeping on their shorts in the event of a major escalation. Maybe they're more forward looking in the sense of, when we have that, currently we have that synchronized tightening of monetary policy around the globe. So maybe they are pre-positioning or keeping that positions on, but it just seems strange that we haven't seen a big enough squeeze or a big unwind in that position already. And as this type of stretch positioning is normally seen as a contrarian signal, we are happy to stay long the Aussie dollar right now, despite everything that we've seen in other markets. I think it's also been quite telling the way that the bond market has been reacting, as well as the Aussie dollar. It just seems like the markets aren't believing the RBA's dovish facade anymore. I mean, we had RBA's Harper coming out last week, and he said that financial markets are misguided in thinking that the RBA will follow the Fed when they start raising rates. And he said that the bank has more than enough reasons to wait right now in terms of monetary policy. Now, it was quite noticeable that despite that very strong pushback from RBA's Harper, that we didn't see any real change in terms of the Aussie. We didn't see any change in the market's expectations for rate expectations. If we take a look at our weekly fundamental drivers report, we can see that rate expectations for the RBA has barely changed, right? We're still looking at about 6 hikes priced in for this year. Now, do we think that is aggressive? Of course we do. We don't think we get to 6, but the same can be said for other central banks' expectations as well, looking at the RBNZ, the Bank of Canada, the Fed, the ECB, the Bank of England, even the SMB. We don't think that these central banks get close to these expectations. But again, it shows us that the markets aren't really believing what the RBA has had to say. If we take a look at the bond market's reaction, barely flinched on the back of these comments. So that shows us that the markets right now just isn't believing the RBA when they're trying to keep up this dovish facade. And again, I think that bodes well for that upside bias for something like the Aussie CAD. So in the week ahead, what will we be focused on now? We've got two things we'll be focusing on for the Aussie and for the Aussie CAD specifically. The first one is risk sentiment with everything going on between Russia and Ukraine, of course. And then the second one will be, and probably the more important one, will be that wage price index data that we get released on Wednesday. Now, why is there all this fuss about the wage price index? I mean, we've spoken about this quite a lot recently. Why all the fuss about this print? Well, we need to keep in mind that the RBA thinks that for them to be able to reach a sustainable level of inflation that is well within their target band, that will require wage growth to recover from its slump that we've seen over the past couple of years. I mean, if we take a look at where we were trading back in the global financial crisis, it's just been a one-way train to the downside after that. So they really do need to see this recover. And they've touted a price level close to 3% for them to think that there will be enough wage pressure to keep inflation sustainable. Now, they have recently said that, even though 3% is what they were looking at, it's not a hard target. They can move in rates before it reaches 3%. But because they are so focused on wages and they think this is really like the linchpin for them to get back to more sustainable inflation, that's why this print is so important. Now, of course, this week we've got this print coming up. And if we take a look at expectations, we can see markets are expecting it to grind higher to 2.4 from 2.2. Now, if we take a look at that chart one more time, we can see that if we do reach 2.4, that'll put us at the highest wage number going back to 2014. So that should be positive for the bank. But because 2.4% is expected, we are selfishly hoping for a higher print here, given our Aussie longs at the moment, looking for something higher than 2.4, because if we get something higher than 2.4, that probably sees the markets pricing in a higher probability that the RBA will move on hikes, probably as soon as June, maybe even earlier in terms of expectations at least. Now, the one caveat to this, though, is there was an article in Bloomberg over the weekend saying that the overall border reopening in Australia that's kicking off this week, that could see the current tightness that we're experiencing in the labor market, that could see some of that tightness fizzle out because there will be a huge inflow of new workers into Australia. And we can obviously see that, the total arrivals has been one of the key drivers for that tight labor market. So some economists out there are saying that, hey, the moment when these workers come back into focus, the moment we see those international borders open up, maybe that removes some of the tightness in the labor market, and maybe that forces wages down again instead of up as the current expectations are. Now, even though that is, of course, a clear risk to monetary policy and something that we would need to keep a very close eye on, we doubt whether the markets would really be too concerned about that for now, at least, in the short term, because currently with unemployment sitting comfortably at 14-year lows, there is more reasons for them to get aggressive instead of reasons for them to stay patient. So even though this is a factor for us to watch, we don't really think this is going to be a major game changer. So what are we looking at then in the week ahead? Well, firstly, we're looking at that wage data. If we get a nice beat, something above 2.4, which is also the market's maximum expectation for this print, I think that sparks up additional expectations that the bank is going to hike rates, possibly earlier than June. Even if they then don't hike as early as June, as long as it sparks expectations that it will, it should be enough to provide some additional upside for the Aussie dollar. The risk of this, of course, to the downside, is that we get something below the market's minimum expectation. That might not be enough to completely change the market's mind about where the RBA is going, but it might see the markets pushing out some of these expected hikes. And that, of course, can start to weigh on the Aussie in the short term. And that will be a clear risk for us to watch in terms of that Aussie CAD long. Now, the other factor we're watching right now is just the overall risk sentiment in the markets with everything going on between Russia and Ukraine. We've had a lot of ping pong, over the last 2 weeks, escalation and then de-escalation and then escalation and then de-escalation. I think despite all of that, the fact that the Aussie has remained so resilient for me, again, gives more confidence that we want to hold on to those longs, more confidence that we're going to see a continuation of that trend. And we do still see quite a lot of catch-up potential for that pair to develop. So the one thing just to keep in mind, though, is that because the Aussie dollar is seen as a favorite risk proxy, just because it kept up very resilient last week doesn't mean that it's going to keep staying resilient in the midst of these types of escalations. So there is always the chance that we get a bigger military confrontation and the markets just run for the exits in terms of risk positions, flooding into safe havens, and that is more than likely going to create additional downside for the Aussie dollar. The one thing to keep in mind about the Aussie CAD specifically, of course, is that if we do get a bigger military escalation, if we do get things like energy sanctions, that is expected to be supportive for oil prices. And if we do see oil prices popping to the upside, that is, of course, expected to be more positive for the CAD. So in a really, really hairy situation, negative risk sentiment weighing on both the Aussie and the CAD, but then having a supporting factor from an oil perspective, that can be a recipe for sizable downside in the Aussie CAD. So it is a risk. Again, I think it's been very positive to see that despite last week's escalations, the pair continue to grind higher. I think that speaks volumes about the current sentiment around this pair. But again, we need to keep that risk sentiment in mind as a clear risk factor. So in the week ahead, any type of de-escalations, we would expect to see upside for, very much like we're seeing today with the odds of or the report saying that President Putin and President Biden might be, looking at a summit if the foreign ministers' talks are successful later this week. We've already seen a pop to the upside, so de-escalation seeing some upside. But in the same scenario, if we see further escalations taking place, we would expect that to weigh on the currency pair as well, and that remains a clear risk factor in the week ahead. So guys, with that said, hope everybody has a successful trading week ahead. As always, any questions, don't hesitate to let us know.